Well, greetings everybody, and thanks for coming out on a chilly December evening. My name is Mark Robertson, and I'm joined here by Nick Strategos, and Ken Cavula will probably join us at some point during the session, or maybe not, depending on how his the festivities at his investment club meeting go tonight. But what I this is kind of an experiment, as many of you know. And by the way, the list of attendees tonight is like a who's who or a Hall of Fame of charter manifest investing subscriber member, charter members and people that we've worked with for quite a long time. And it really is kind of cool to see all of you come out. This is experimental. I could see doing this on a limited basis, but doing it much more often than we have. I really did want to flex our GoToWebinar license here before the end of the year. And I could see just coming out and doing a quick stock every now and then or whatever. But the important aspect is we're going to just throw out a couple of topics. Nick and I are going to wrestle a little bit. The Penguins usually win when they wrestle with Red Wings, so everybody be forewarned. But really, it is a matter of just searching for things which you guys want to talk about and dig in a little bit deeper and perhaps share some of the mysteries of the madness that goes on at Manifest Investing. But anyhow, welcome to all of you. You can see that our feet are up with our toes pointed towards the fireplace and trying to stay warm and keep it casual, informal, and let's just have some fun. You okay with that, Nick?
Absolutely. I'm always up for fun, especially when it comes to investing topics.
Very cool. All right, so the topics that I threw out, I've gotten a number of requests, and I'm overdue with getting the actual cover story feature out, and I'll have that out in the next day or so. But we'll hit the highlights tonight and go over the list. Some of the people that have actually sent me some emails, so I will have that out. But we'll go over the list real quickly tonight and just share some of the highlights. Then I did want to talk a little bit about the Groundhog Challenge, and I heard back from at least 5 or 6 of you that said, why don't you cover just the basic topic of how you find stocks, and perhaps with some emphasis on what you look for the best small companies list, that sort of thing, because we're all gearing up for February 2nd, 2020, the next Groundhog Challenge. We'll talk about the state of the current contest, and now's a good time to be hunting those down to basically build a groundhog pounce pile. You working on yours yet, Nick?
I'm always working on it.
Always looking for an opportunity.
Yep.
All right, so let's go ahead and get underway. Have to do this one because we will talk about real companies in real time. No investment recommendation is intended. This is about education. We'll be talking about the types of methods and analysis done by the Modern Investment Club movement, and how we look at companies at Manifest Investing and within this community of long-term investors. So we may hold the stocks. We will try to mention it, as Nick and I were just admitting in the green room. We're happy that we hold Ardelyx, that crazy stock that Hugh brought us a while back, and you'll see we'll talk about what it's doing to the groundhog contest here in a few minutes. But if we own them, we'll try to let you know, and just keep in mind that bias could be there. Sometimes we get angry. Sometimes we're happy with our stocks. We do a monthly roundtable, and then we do probably every other month we do an investing topics with Ken Cavula. And so if you'd like to be added to that reminder list, or if you know somebody would like to be added, ncavula1@comcast.net, please let us know. If you have any follow-up questions, suggestions for future topics at something like this, or just general Q&A that we don't cover, markr@manifestinvesting.com. And I'm not always going to prepare a series of slides, but we did actually have a series of slides to go over that I thought we would use tonight for just a few minutes, and then we can go pretty much wherever the audience wants to go. But I did have to dig out my reindeer, because that's just absolute photographic evidence, proof that the reindeer stuff is a myth. And it really is those rhinos that take care of Santa Claus and the market and everything else. But Thought we might have some fun here because this one kind of surprised me. So without looking it up, and you can put your answers in the question tab or write them down, but what is the total return on the Wilshire 5000 year to date for this year? I'd like you to take a guess, write it down, or put it in the questions tab without looking it up. I can hear some of you out there on your cell phones.
Well, we're getting some answers.
Let me see if I can see the answers.
I've got 3 answers so far. Feel free to join in. Everybody's welcome to play.
Are they putting them in the questions tab?
They are putting them in the questions tab. Yep.
Okay.
I have it open so I can read them back. Yeah, a pretty good, pretty broad range. We're up to about 7 or 8. Anybody else wants to jump in, we'll start sharing the range here.
Okay, why don't you read them off, Nick? Give us kind of the range that we're seeing.
I have a low of 8% and a high of 34%.
Okay, and in general, they're running.
We have 8, 13, 18. We have a 10. We have a 30. We have a 28, a 23, a 13, a 34. So they're all over the place between 8 and 30. 8 and 35, 34.
Okay, so let me confess, I do this stuff every day, and I was actually crunching through a spreadsheet and pulling in, historical numbers to look at year-to-date returns. They happen to be for Eddie Elfenbein's 2019 buy list. By the way, Eddie's at 30% year-to-date.
Mm-hmm.
But I was looking at the reference benchmark, and I was, for whatever reason, I was thinking 18, maybe 19%.
No, it's mid 20s. I'm going to say about 26 myself. It was 24 and something at the end of November.
Yeah, and we've had some good days.
Yep.
And the actual answer is, well, depending on how you measure it, the Wilshire 5000, which is our favorite method generally, using the VT SMX, that's the mutual fund for the Wilshire 5000, is 26.8%. So call it 27. Now the S&P 500 is a little bit higher than that at 27.4. And let me go ahead and go to the next slide. Shows you the answer, 26.8 from the Wilshire 5000. And if you're in that group of people between 10 and 18, I was there with you mentally. You got to remember, we got crushed last December. And that's what's kind of showing on the slide there with that green area. And we came out of December, with as much carnage as we'd seen in quite a while. And the recovery from that has actually been a lot stronger than most people realize.
Uh-huh.
And then the other thing that I do like to point out is when you look at an equally weighted S&P 600, that's the small caps, they're up about 18%. So they have actually continued to take quite a hit, quite a deficit, or they're trailing the Wilshire 5000 quite a bit. So, and they had a rough year last year. So to me, that says opportunity. I mean, they have really taken a couple years off, although 18% is a pretty good year most years.
Oh yeah. No, I have to watch a little closer for work, so that's why I kind of knew it was in the 24, 25 range
Right.
at the end of November, because at work we rely on our portfolio as a nonprofit to help fund a little bit of operations, and this year we've had a lot less wringing of hands because of the performance of the portfolio. Last December was not quite very much fun, but it did come roaring back. So,
yeah, and this slide is for those of you that haven't seen it before, although I think everybody here has. You're basically looking at the blue bars are call it the average, you can call it the median projected return of all the stocks in our coverage universe. So you're looking at all times at least 2,200, usually 2,400 stocks. And that blip up in December of 2018 was definitely special. You can see that V notch on the right-hand side. That was a painful moment. And I think one of the things that our community does better than just about anybody else is when we have one of these moments, when the stock market itself takes that V notch dive downward, as long as the return forecasts on our stock studies go up, we actually sleep better at night, and we actually do some pretty focused shopping under those conditions, and that really does set us apart. The other thing that you're going to start to see a whole lot more articles about is, ever since December, there's been quite a bit of people exiting the market, and again, especially with all these gains here in the last few months, the amount of outflows from ETFs and mutual funds that are stock or equity based is, I think it's reached multi-decade high levels, and it'll be interesting to see how that unfolds, because that often can be a contrarian signal that we've seen many times in the past. These people generally run for the hills at the wrong time. So again, I just think it's kind of cool that the stuff that we do kind of keeps us. It's kind of like a behavioral science remedy. The stuff that we do for many people, and then especially those of us that are in investment clubs, can really bring some of sanity and calmness to everything. Mm-hmm. Any comments or questions on that?
Well, I have one that's Len wants to share. He said he was looking at the perf graphs on stock charts today,
mm-hmm.
and the comparison of the S&P 500 versus 400 and 600. The 500 was higher on the 200-day moving average.
Yep.
So.
Yep, we've been looking at that too, and the 600 trailing the 500 just means that there's more opportunities in the smaller companies.
Mm-hmm.
All right, let's go ahead and keep pressing on. That takes us to our subject, and again, I apologize for not getting this cover story out sooner, but I've been dealing with a few things again, including a twisted nerve on the right side of my body, which is just causing me all kinds of interesting. My wife has a theory that it's a sympathy pain with our daughter who's 9 months pregnant. and her sciatica nerve is driving her crazy. Well, that's not my cause, but I'm having some similar pains. Anyhow, most of you know the story. Ken and I basically drifted away from the Forbes thing when they abandoned their monthly or their annual feature on the small company stocks 5 years ago. And we decided to focus in on companies the way that we know we should focus in on them, looking for excellent, promising small companies with outsized returns. So great companies at good prices, that same type of thinking. And for the last 5 years, our results have been quite strong. You can see, therefore, we do it from Halloween to Halloween. So Halloween to Halloween. It's another thing that messes me up on the year-to-date numbers, right? Because we do different calendars. We do Groundhog Day to Groundhog Day and Halloween to Halloween. So I don't handle calendar stuff very well. But you can see we did outpace it for the year ending October 31st, 2019 for the 5th consecutive year. Those numbers are getting kind of cool. In fact, we keep, if you look at the performance of the stocks we have chosen, they keep up very well with some of the leading mutual funds that we'll be talking about here in a few minutes. Now, this year, we're off to kind of a slow start. Now, notice the scale change. It's 1% versus 3.9%, but we have gotten off to a little bit of a slow start. Some of that I would blame a little bit on potentially swinging for the fences a little bit, carrying a little bit, dialing down the emphasis on quality. Might prove to be the wrong time to have done that. We'll see. It's early. We're only a couple months into it, but we are starting out a little bit behind. Now, for those of you that wanted a copy of the list, here are the 20. What you're looking at here is through yesterday's close. The actual price at the time of selection is the cost, and then the price yesterday. So you can see the gains in that annual return column. And again, we keep track versus the Wilshire 5000, and we basically benchmark all investments against just a mirroring or matching investment in the Wilshire 5000. So you can see about half of them have beaten the market since Halloween. Some of them fairly impressively, like biotelemetry, is actually up 19.4%. The biospecifics, both of those were fairly recent roundtable selections. Ken actually added Planet Fitness this year with some of his work. We discovered some of these through the work of Marie Frank. I know Marie's here tonight. But from top to bottom, that's a fairly decent list. And the ones at the bottom have disappointed us a little bit. We did add a couple chicken-related stocks between Wingstop, which has recovered. That was actually down about 20 or 30%. And after Halloween, and Shake Shack hasn't recovered much. So we have a couple kind of similar type restaurant entries in there. But NV5 Global has taken a pretty good hit. We're going to take a closer look at that one. Any comments on any of these, Nick?
No, I disagree. I mean, it's just off to a slow start, and but you have a good range here. There's some really good studies there. Yeah, I agree. The BEAT and the biospecifics both came into the roundtable, and they're very interesting studies. So, but this in and of itself is a nice shopping list for just about any of us.
Yeah, and I look at this type of a list, keeping in mind that I still believe the January effect is out there. It's just different than it used to be. Some people are writing that it no longer exists. I think the problem with it is that it spreads into September, and people begin tax-related selling, during the fourth quarter. They don't wait for December anymore. It used to be really prevalent and obvious back about 50 years ago, and so now you've got tax-related selling going on during the whole fourth quarter, and that means that it is, especially with our personal portfolios, even outside of our investment clubs, you take a list like this, I start sniffing around at the bottom.
Oh, absolutely.
You look for the company that maybe has a misunderstood challenge or something like that. Mm-hmm. And so the ones that have done badly, the ones at the top are still fairly promising. We'll look at that. Best way to look at that, in our opinion, is to go ahead and pull up a dashboard. Here is the current dashboard, sorted from highest return forecast, the projected annual return on the right, all the way down to the lower side of the equation. Fox Factory, that's gone up almost 5%, but it's actually dipped down to a return forecast of 12. And I think you can get a kind of a feeling here for, we did do a little bit of fence swinging here. You see a lot of yellow. That yellow means potentially too good to be true. Those returns could be a little elevated. Could be other shoes waiting to drop. And NV5 Global up at the top, because of the 36% price drop, now has a projected return in the 30s. And it is legitimate and fair to wonder, what's really going on there and what kind of things are happening. So we'll take a closer look at that one. But again, shopping around at the top of that list, especially for some of the higher quality, higher earning stability stocks. One of the things I probably did let down a little bit on, because Ken and I were really busy in the days leading up to Halloween, because he usually puts me on the rack and forces me to have minimum standards for financial strength. Is he here chuckling in the background, or is that?
No, that's me.
Okay.
He's not here yet.
Okay.
So I just the vision of Ken putting you on a rack just got to me. So.
But minimum financial strength might matter. Now, the earnings per share stability, we do give that a little bit of room to run, because sometimes that can just be a hotbed for opportunity if something really gets dinged. But again, from top to bottom, the higher potential stocks up at the top, you can see that NV5 Global, at least in the current, and we'll probably talk about this a little bit, the data from the analysts is not showing any signs of weakness, at least not yet. Here's a closer look at the company and what's going on. They basically provide engineering and consulting services to municipalities. One of their big projects is to renovate a 450-acre. This must really be some special property out in San Francisco. They're working on like a waterfront park that's 450 acres.
Wow.
And doing the development of it. That's got to be quite a big deal. But they're from Hollywood, Florida, and they've got active projects in California, Utah, Florida, and I believe one other state. Maybe it was Nevada. But they basically do the soup to nuts, project management, construction management, all that type of stuff, compliance and environmental studies they provide all of those services. And looking at that top line, fairly consistent. I mean, obviously, this is going to be a company which is a little bit sensitive to economic conditions and changes in the availability of capital, that sort of thing. But that's a pretty up straight and parallel situation. The earnings have looked pretty solid. They did peak out in stock price in 2018 and 2019. So maybe that's some of what we are seeing with the company, just a little bit of a relaxation. You can see that I did back off just a little bit from where I might have been a month ago because they did have a fairly sizable acquisition which distorted the historical data array. So I had to knock off a couple of historical years of data. The result of that is basically looking at this growth rate and ignoring some of those prior years. And that growth rate is closer to 19%, not 28, because I believe this over here is at about a slope or a growth rate of about 28. You can see that there has been a little bit of a tapering off, and some of that's got to do with the acquisition. So 19% for a growth rate. Their margins have been handsomely improving. The analyst expectations do place it somewhere in that 10% range, even with some relaxation back to an 8 or 9 or 10% range. That's still a pretty respectable situation, very respectable relative to other companies in this field which have struggled with some of the worldwide engineering and construction projects. So sticking with about 10%, again, it could be argued to be a little bit lower. PE ratio, it's been cooking around in the high teens, so somewhere in that 19 range for a PE ratio does give you some confirmation of a projected annual return in the high 20s, even approaching 30. And pretty good situation. They do have a little bit of long-term debt, but they have just as much money in the checkbook as shown here, the 41 and 31. Using that effective tax rate of 21, you do get a return on owner's capital in the low 20s, which is very respectable. And they do have a little bit of debt, as we say, but minimal interest payments, really nice interest rate. And this crushing of the stock price has actually placed it well into the oversold condition of a relative strength index less than 30. Anytime a relative strength index gets below 30 and we like all the other characteristics of the stock, it does kind of raise my interest level in the stock a little bit, especially if it gets down closer to 20. So are you familiar with these guys at all, Nick?
Not at all. I've looked at them once a long time ago, but I haven't come back to them. So I may now, though.
Yeah, they're crunching along pretty well. And again, if that project in San Francisco is any kind of a harbinger of things to come, and if they execute that well, fairly respectable looking company.
Yeah.
So I may dig in a little bit deeper and see what type of threats. One of the things that I did want to point out that's really kind of cool is and you guys have heard me talk about this now for a few months, the data is really pretty phenomenal. This happens to be a company that's in the extended coverage, so it's one that we used to update relatively infrequently, and some of them would get fairly stale. But with the new data from Y charts, they're getting updated every day. So this stuff, so when you're looking at updates that are occurring, and these numbers out here on the far right, the sales out here, these 3 most recent numbers, if the analyst consensus changes on these, we actually get real-time deflections. So all of these numbers can be actually deflecting or changing literally overnight. And I think it's going to be pretty cool to watch and see how that unfolds. That includes the earnings. We're actually using normalized diluted earnings here, and those can also change according to the analyst expectations. And again, it's kind of fascinating to watch, how you'll get a news event. In some cases, we're actually seeing the news before it's news. And I think you guys all know what that could mean in terms of potential for maybe just that little bit of more of incremental advantage in the stuff that we do. So good, clean fun. All right. So with that, here's the Groundhog Challenge. This is the unofficial leaderboard that's available to participants in the contest. And this is kind of fun. And this is Ardelix Fueled. That's the company that Hugh brought and has been at least 5 or 6 times selection at the round table. And that is Hugh's selection last February for the roundtable. So that would be about the time that you bought your stake.
Yep. Yep, it sure is. That's probably what drove me to it.
And so he added it as one of the 4 companies, and you can see that the 4 of us have managed to capture the lead in this. Now we're not eligible to win it officially, but we can win it. We can win the Rhino version of the title. But Hugh has actually won this thing a couple of times, and he's on his way to winning again if Ardelix behaves itself for the next couple of months, and that's a big if.
Yes.
But, that we all watched it go from 8 down to less than 5 in a matter of minutes not too long ago, and now it's back up above 7 again. But K Light is up there. I don't know if K's got. I can jump out and we can take a look and see what's actually fueling K's portfolio. Let me go ahead and jump out of the slides and go to that. We'll slip over to the actual contest. I know mine is completely fueled by Ardelix. Here's the roundtable selections. You can see that 250,000 invested into Ardelix is now worth 850, and that's always fun when it happens. And we've got EPAM, which has also done very, very well. TJX, which was probably Ken's pick, which has also probably outperformed the market. That's over 20% above the market. And then one of the 4 of us picked Health Insurance Innovations, which was one of our selections for the small companies last year, and I'm sure that was me.
Yeah, that's in mine too.
So anyhow, kind of hard to argue that we're winning. Here's Hugh's actual selections, Ardelix, and then he's got this other one. I can't even pronounce it. KPTI is the symbol, and that's done pretty well. He's actually done fairly well with Campbell Soup, and you can see that he's added a couple others there. We'll try to add Zafgen to coverage, but that has not done nearly as well. But I don't know about the rest of you, but when I have one that does as well as Ardelix and one that does as poorly as Zafgen, I tend to notice the Ardelix one. It kind of offsets the other one. So that's Hugh's. And let's take a quick look at Kay. I think I saw Kay's name on it. Yep, she's Ardelix fueled too. Got a couple other nice entries there with Air Lease and Gentex. So she went 5 ways. So that's $200,000 invested into Air Lease, Gentex, well, all of them, but $200,000. So she's above water with 4 of them. Boy, CVS is doing better these days.
Yeah, it sure is.
So let's go down and check. Here are the ones that were most frequently chosen by participants this year. We call them the heavy hogs. You can see that Ardelix, Air Lease, Facebook, CVS, Amazon, they're all doing actually fairly well, with the exception of Alliance Data and Align. Align is that. What are there? 10 of them there.
Yeah.
So anything above 100,000.
A little bit underwater.
Yeah. Mm-hmm. But Alliance has been quite a struggle for many of us. Just for kicks, we'll go in and check me. Yeah, there's Ardelix. NVIDIA's actually done pretty well. I fell into the Canada Goose trap.
I'm glad you said trap.
And are you on here? Let's see.
Oh, I'm down near the last page.
Oh,
there's my investment club.
Sirius Pittsburgh. Well, you guys are in the running for that.
Yeah, we are.
You should point out that Bauer City, Susan's club from Janesville, they've won a couple of times, and the actual leading club is another one of Herb Lemkool's. This happens to be his grandchildren, and it's modeled after their actual portfolio. So there's not much space between these two, so these can move around. That's Ken Kavula's family club is in here, and a new entry from St. Louis. And here's Sirius. What'd you guys pick?
We picked, these are 6 stocks were the top par at our meeting in January before we made our picks. So these were 6. We actually, usually we pick 5, but there were 2 that the par were dead even, so we went ahead and went with 6.
So your screening criteria was basically par. Did you limit it to any?
We limited it to our portfolio. These were companies that we owned at the time.
Oh, okay.
So this is real live, real money invested in all these. Although some of them we've since gotten out of CVS, we've since gotten out of Lamb. So, but those were real companies that we owned, real dollars in our portfolio in the club.
Well, cool. And again, you're cranking away at one of the neat things about putting $1 million, groundhog dollars, into the portfolios is you could tell that this is up 19.4% by the total value of it. And if I do another one of these before the end of the year, certainly before the groundhog, I'll show you how the Y charts data is going to make it so we can have an official scoreboard next year that will be continuously updated for stock splits and dividends, which is why some of these are off by a little bit. You guys all know the drill. When February 2nd rolls around, I usually had to basically get a stack of pizzas and some adult beverages and spend a whole bunch of time calculating out corrected for splits and dividends, because we do include dividends in what we do by the original adjusted price for dividends. So that would take me hours. I can now do it in about 10 minutes.
Oh, wow.
And it'll be interesting to see how that goes going forward.
Mm-hmm.
It takes the pain out of it.
Yeah, if you keep going down, mine's at the bottom. Mine's in the stamps.com crowd.
Oh, okay. Well, yeah, Stamps got a few of us. And the other thing that's really kind of cool, because this is true year in and year out, you can see that there's a bunch of people down here around 1 million, but the thing to notice, where's the benchmark? Well, here's the Wilshire 5000, which is up 15.1% since Groundhog Day. What I want you to notice is the scrolling that goes on. There's quite a few entries that are beating the market. Mm-hmm. And we see that on a regular basis, anywhere from, I would say in a typical year, anywhere from 40 to 60% of the entrants beat the market. And that's fun. That's just simply fun.
Yeah, it's really cool.
It
means we're all doing something right, is what it really means.
It does, although there's a lot of people that tell us it's not happening. It's just amazing when we run into that. All right.
Yeah, so it's not the folks under the tent.
No. Nobody here tonight believes that.
Right.
I get that. So I thought we would just review, and Nick had sent this suggestion along with 3 or 4 of the other attendees that are here tonight. Just a reminder, what type of companies are we looking for in those small companies when we go shopping for them at Halloween? The biggest message is you don't have to settle for roller coasters. You can find well-managed companies, excellent companies, and this is a theme that many of you have heard at our presentations around the country. So quality does matter. Up, straight, and parallel can be found in a smaller company. The sales growth forecast matters, so we try to find double-digit sales growth, hopefully above 12 if we can, but we basically are looking for double-digit sales growth. We do try to limit the size of the company by the amount of revenues, with some latitude. There is some real flexibility here, although Ken did refuse to let me put in companies at 1.6 billion. He just said, no, they're not small, and he was stubborn. He was very stubborn. So we actually ended up with 20 companies that end up at $1 billion or less. The annual revenues, we just didn't want them to be too small, but every once in a while, you can find that well-managed company that's still in that very small range in terms of annual revenues that can be quite the portfolio engine. I'm thinking of Chuck Allman and his years with Mocon. Mocon was a relatively small company, probably literally in his backyard, and Mocon was a tiny company, probably only got to 40 or 50 million by the time Chuck had owned it for 40 or 50 years. But his rate of return on Mocon was something like 60% per year. So that, in his portfolio, which was always pretty heavy in cash because he was so grumpy and bearish, the companies like Mocon carried the portfolio. We do keep the penny stocks out of it, and we did keep out most of the asset-based businesses like banks and insurance companies. But again, anytime you find a bank above 12%, you want to check your math. There are a few, but anytime you get an asset-based business growing that rapidly, you want to check your math because they're just not going to happen that often. So again, excellent quality companies that fit those characteristics with a decent return forecast. That's literally what we've gone shopping for. What some of the people responded this morning to the what do you want to hear about? What are our favorite sources? So I just want to reinforce that the places we turn is, again, our traditional screens, the companies that we cover in Manifest Investing, but at the same time screening outside using the Better Investing screen, using the Morningstar screening for high growth, all that type of stuff. With our wire charts data, we did discover some companies just using traditional screening for companies that had consistent fundamental characteristics that fit what we wanted. But I will tell you, hands down, our two favorite places are community members submitting, hey Mark, here's a hot one, or Marie Frank send them to us 100 at a time, with your list of 100 fastest growers. A couple of them actually made the list off of that nomination. But literally, some of you have heard me say this, sitting down opening up my email first thing in the morning and finding an email. Hey, take a look at this one. I think this one might make it. Those are the coolest ones ever. And there's a handful of them that make the list in that way. So that's one favorite place. But the other one is in what we consider to be a vetted field of opportunity. And the three funds that you see listed there are three of our favorite places to watch for ideas for stocks to study. These happen to be three funds which specialize in smaller companies, and they have tremendous track records, so they know what they're doing. And we think it's just really smart to watch over the shoulders of people who really know what they're doing. And so when we're looking for smaller companies, because the quest for small companies in your club or individual portfolios never ends, so this is a never-ending process. In fact, some of the stuff that we shared with our audience in Seattle is just staggering when you think about some of the potential of watching these well-managed people who know what they're doing and some of the ideas that will be generated. We'll take a closer look at that. But you can see one of our favorites is that Brown Capital Small Company. They're the only, as far as I know, they're the only fund or ETF out there that calls it small company, not small cap. Small cap and small company are not necessarily the same thing. Mm-hmm. We're after small company. And you can have small caps you can have mega caps that become small caps because of a breakdown in the business in the great garage sale. So we are looking for small companies, and that's one of the reasons we really like Brown. We've talked about them quite a bit. David Gardner does give us some ideas. We do find some ideas in the Hoover's Emerging Handbook, which you can get secondhand at Amazon, and a number of clubs and individuals have done that over the years. And Chris Jenner is at Rock Springs Capital Management. Really, in fact, he's the source of the biotelemetry and the biospecifics companies that are in the list right now. All right. So again, one of our favorite places to turn, and this happens to be, by the way, this is one of those lists that's now used to take me hours to do, and now they're all continuously updated real time. So this is as of today. Since October 31st, 2010, so we're tracking the last 9+ years, the companies in this top 10 list have generated a return that beat the market by anywhere from 1.7 up to 7.2% per year. So those guys up there at the top, this Virtus KAR, and by the way, KAR stands for, I didn't know this until today, stands for Kane Anderson Rudnick. That's actually an investment advisory firm, and I didn't know this either until today, in Beverly Hills, literally within walking distance of the sidewalk where they have the stars in the,
oh, wow.
in the concrete. So
Hmm.
that is where they have their office. So think about the stars. Um, so Virtus KAR is the top performing one, so we'll take a look at that. T. Rowe Price New Horizons is always a good place to keep track of, but what we'll demonstrate here with Brown and with Virtus KAR is the listing that you see there is can be found in Morningstar just by going into Morningstar, entering the ticker symbol BCSIX for Brown, small company, and then clicking on the portfolio tab. The direct link is shown at the bottom of the page if you want to click that on your machines, but you're going to be looking at a list of companies. And what is really cool about this one, these guys have extreme conviction. They find really cool smaller companies to track, and I want you all to notice, because I'm not sure I even gave these guys full credit for this in the past, there are companies in that portfolio that have been there for 25 years. Cognex being one of them. There's a couple more that are listed on the longer list. They only have 30 or approximately 30 companies in the portfolio. And if you see a name on here that you're not familiar with, you probably want to become more familiar with it. Neogen, that Michigan company that we've talked about for years. This one is really fascinating. I don't know that much about them. Is that one on your radar screen, Nick?
Yeah, I've looked at them before too, but it's been a while. I think they popped up. I want to say they popped up at a roundtable too as a mention.
I think they probably did on screening results or something.
Yeah, on the screening results, we talked a little bit about it, but I delved into a little bit, and I think they're early stage, and so there's not a lot of data yet on them.
Yep. So we'll talk about that too. I mean, so sometimes you will run into fairly early stage, and maybe you want to watch them come along a little bit faster. Um, but one of the neat things about our data is now we are looking out to the next year and the year after that continuously. So you start to see some fairly interesting situations. In this case, notice also that Brown has been accumulating Glaukos. There's only four stocks in the portfolio that they've actually been accumulating this year. This iRhythm, substantially or significantly, and then these two at the bottom, Appfolio and Ironwood Pharmaceuticals. So again, some of those might be fairly early stage, although Ironwood has a regular PE, so that one's probably a little more mature. But you can see,
And Appfolio snuck into my groundhog last year, so I was familiar with it back then. But I think I might have heard it somewhere else. And it's interesting that they've had it since June, and I heard about it before, so I didn't get it from here, but I did get them from some other source that I'm not recalling right now. But I think they're my top performer in my groundhog this year.
Appfolio is?
Appfolio, yep.
Okay. Well, there you go. So there are some interesting companies on there. You can see these guys were on to Cantel Medical. That's a
Yep.
company that Ken presented at a roundtable a couple months ago. You can see this goes all the way back to 2010. Those guys. I know that's one that Tom Gardner has actually followed for longer than that. So he sees some potential there. Alarm.com. That's one that I presented at the National Convention last year, and that's
Yep.
actually done quite well, although it's taken a breather for a few months this year. I'm pretty sure I'm up 20 or 25% annualized since the day of that meeting. Inogen, I think that's an excellent study to be on Pounce Piles. That's the company that makes the small portable oxygen packet. It's kind of like you can literally wear it on your belt, weighs about a couple pounds, and it
Right.
eliminates the large steel tanks.
Hmm.
And if you watch for the commercials, you'll see them. And the interesting thing about Inogen, just stealing from some of Ken's discussions, Ken actually has a proprietor that owned an industrial gas business in his investment club. And that individual, along with some of the medical people that are in Ken's investment club, basically predict that Inogen is going to make the steel tanks obsolete, and many
Wow.
hospitals are going to be retooling with Inogen-based equipment. So it's something to be aware of. Like I say, put it on your pounce pile to watch closely. And
It's been on my pounds pal for a while, so yeah.
yeah, so that's a good one to look at. Let's just talk about these guys from Hollywood. As it says right here, they've got their office on the Avenue of the Stars in Beverly Hills. This is a fund that's closed to new investors, so we really are talking about just borrowing ideas for stocks to study. You can see the name of the firm there, but they are not adverse to investing in fertilizer and swimming pool chemicals and small bank software, all that kind of stuff. This is the top performing mutual fund on the planet for the last decade, and they keep delivering. You cannot buy it directly, but you can watch what they do, and that's kind of what we've been advocating here. Here's their list, and again, there's only two companies that are not on. This is their complete list of stocks, and there's only two companies, and one of them was Mesa Labs. Their smallest holding is Mesa Labs. I don't remember their next smallest, but again, from top to bottom, you see some multi-year holding periods. They tend to be pretty faithful. The Chef's Warehouse has been there since 2012. PriceSmart, one of Kavula's favorites, since 2011. You see a number that are pushing up on a decade, and there's actually only two that they have in a material way accumulated in the last quarter. That's what these numbers would be. Share change between June and September. And obviously these will be updated in a few days with the end of the calendar year. But there are two companies which kind of jump off the page. Ollie's, which Ken and I have actually, it's been on the small company list in the past. It was a candidate to make it this year. And I'm not sure why he persuaded me not to include it. But the point is, the guys at Virtus, KAR, have been accumulating it pretty heavily. And by the way, it was the highest gainer on the stock market today. I think they gained 13 or 17% today. So who knows? But down at the bottom, there's.
But you can also see too that they've had a rough go of it. I mean, their 1 year return is a minus 12, almost 13%.
Yeah, so perhaps they see that. The guys at Virtus may see that as a buying opportunity.
Absolutely right. Mm-hmm. That's what I would think too. Is what they're seeing is the price is beaten down, but the fundamentals haven't changed. So let's go for it.
Yeah, Ollie's is an interesting study. We probably will take a closer look at that in the not too distant future. They've got decent margins and appear to be executing pretty well. So anyway, there's a bunch of household names on here, so that tells you that they think like we do. There are some here that we could discover. Copart up at the top, 2008. I noticed that one. FactSet from 2006. But the one down at the bottom is the new one. That's a brand new position within the third quarter of 2019. You can see that here. I had not heard of this company before. Opportune Financial Corp. The ticker symbol is OPRT. And here's just a quick look. I just looked at their investor relations. This is a very small company, and it's not flashy. Their mission is to provide affordable financial services for customers who have a hard time with financial services for a myriad of reasons, from bad credit to no credit, what they refer to as the invisible and misscored U.S. borrowers in the country. It's not a subject that some of us will be terribly comfortable with. But what these guys do is they fill a need, and they have some type of algorithms or systems that handle risk, and they basically work with these people to rebuild their credit scores, establish credit scores. Their management team has credentials from all the major credit services organizations. It's kind of a fascinating thing. And the thing that should be playing in the back of your mind is that Virtus, KAR, is looking very closely at these guys. And they're studying very, probably diligently. And they've captured their attention. They see something. They think like we do. Maybe we need to keep an open mind and just think through some of this stuff, because this is a large market that is not served terribly well. I've helped people that toil in this market, and it can be extremely frustrating and extremely expensive. I mean, you and I write checks virtually for free, and some of the people that are in this cohort that's being talked about get charged like $10 or $20 for $100 check. that starts to get just really, really stiff. So that's who they're working with. Um, kind of the middle to lower income, multiple jobs, 42% are supporting a family. So again, it's a group of people that need some help. And obviously they can be very high risk also. That has to be something that's managed fairly carefully. And here just gives you a little bit of a graphic that talks about the cost of borrowing $1,000 and where they sit in that profile. So if they're able to do this, make those people happy, improve their situation, retain them as customers, or hopefully make it so they graduate from the condition that they're in, whatever that means, you can see fairly substantial savings. So if they can still generate the type of returns that they're targeting with that experienced management team, and again, what should be playing in the back of your mind is Virtus are looking at this very carefully, and they see something compelling about the story. All right, so here's the look. Again, relatively new company, very early stage. They do have a 6-year track record when it comes to revenues. Well, actually, 4 years of track record, 2 years projected. I think I will be very carefully watching where the 2022 estimates land here in a few days, because we're only a few days away from that.
Oh yeah.
The earnings are they're there. At least they're there. Unlike some of Hugh McManus's stocks where there is no blue line. But again, we're talking about a $600 million company with 1,400 employees, almost 1,500 employees, that has a growth rate in the high 20s. That if they can do this, if they can actually manage the enterprise that they've chosen to pursue, notice how tight this scale is over here. We're basically talking right around 8% net margins. And PE ratios in this realm are in the mid to low single digits. So again, we're looking at 8 for a PE ratio. So again, it's all going to come down to, do we really believe that they can serve this higher risk cohort and generate those type of margins? If they can, again, we're looking at a 24% return. You can see that they have a little bit of debt, a little bit in the checkbook, decent return on capital. Probably not on sale today, but if I add them to my list and I continue to see numbers in this range, and if they ever do fall into a oversold condition, could get interesting. So it's one to watch and try to figure out what these guys that have the best record in the mutual fund industry for 10 years, what do they see?
Mm-hmm. Yeah, I have a feeling that's a pretty big underserved marketplace too. That low income area where they're really living paycheck to paycheck, literally, and if they can put less of their paycheck out for expenses like this, in interest payments, then that's just going to help them get themselves out of where they're at and get moving on with their life.
Well, I was with a colleague not too long ago, and he was attempting to cash a $50 check, and one of the major banks charged him $5 to do it. And and it's like I think we take that for granted. That starts to pile up when you run into that on a regular basis in your life.
Right.
So it's a field of opportunity, and how they pursue it will be interesting to watch, and we'll see where it goes from there. How are we doing on time? Any other comments or questions, Nick?
Well, we just had a couple of things thrown out here. A reminder that Ollie's CEO passed away over Thanksgiving.
Who's CEO?
Ollie.
Oh, yeah, I think I knew that.
Yeah, he passed away over Thanksgiving. That's from Len. Len also tells me that there is, according to Simply Wall, Francois Tardin is the independent director of NV5 Global, and they sold 100% of their shares on December 6th.
Okay.
So an independent director got out of the company, so an insider sold out. So that's the only comments that I have here.
Yeah, and I think there's a post on the Manifest forum about digging in a little bit deeper on the children that are involved and all that kind of stuff. So that's part of what needs to be looked at too.
Yeah, it's probably. I mean, if that like it usually does, it causes the stock to fall. It may put it on a target, put it on in your sweet spot.
Mm-hmm.
So.
All right. So what I'd like to do is kind of do a lightning round here of talking about our return on capital and switch gears and talk about the audit we did on 5. But everybody here can read the slide. If you want much more depth on this, you can go to This Week at Manifest or send me a note and I'll send you a link or the slides. But we actually made a presentation on return on capital and why we think it might be a compelling thing to look at, because it accommodates and accounts for the total capital structure as you're studying the company. And I'll just leave it at that for now. It does it by this basic formula. We decided to use the projected pre-tax income for the companies that we file. I'll show you why. But it literally is the pre-tax income divided by the capital structure represented by the stock price, the debt, everything is per share, and the amount of cash, literally. And then that comment, which is kind of haunting and encouraging at the same time, that this type of return on capital calculation could align with the type of return expectations that we build for stocks. And we did discover when we compared par versus the return on capital for a bunch of community favorites, there's over 100 points on here. Again, the bottom line is that we think that they map fairly well. Again, a perfect match would be right up at a 45-degree line, right up the middle of that graph. And a lot of those are pretty close, and we find that compelling. Here's a list of the companies, from those that are above the line to those that are below the line, and you can see just a whole bunch of community favorites where the two numbers are very similar to each other, especially down the middle of the page. So we find that, again, compelling and something that we think is worth studying more closely when it comes to screening for companies. Some people asked about that today. I do use the return on capital as a screening criteria. We'll talk about that in a minute. So again, think like an owner. Had to get Mr. Potter in there one more time before Christmas. But here's one of the functions that we think it possibly, and again, we're just scratching our heads thinking out loud here. This is where Nick and I get to wrestle a little bit. I think the numbers on the left match up fairly well with your recent presentation to the roundtable.
Yes, they do.
Okay, so 21% growth, 10% margins. This is a wonderful company. And then this is where 34 for some of us is a little bit frothy, but for a company like this, it can make all the sense in the world. But when you subject 5 below to the return on capital equation, which is what you see up here, this is the pre-tax income. Here's the stock price. They have a little bit of cash, and here's pretty sure that's the capital lease.
Yeah, we adjusted the other night. We talked that through about it being the new capital lease rules looking forward. Otherwise, they'd have no debt at all at this point.
Okay.
But it makes sense. I mean, we're looking forward anyway. We're trying to look out 5 years, and if the rules are going to change and we're going to, the numbers are going to have to change too, it makes complete sense to put it in there.
Okay, so basically what this comes down to for us, and just like it says up at the top, is could this be an audit? Could this be a nudge to perhaps consider a slightly lower PE ratio? And my knee-jerk reaction is it makes sense to me that maybe a little bit less PE ratio in my study of a company like this one, it generates a number fairly close to the number up at the top up here. So I see where that reconciles fairly well. And again, I go back to this slide, say, makes some sense to me. What are your thoughts on it, Nick?
Well, after you asked me about this today, I took that roster that you put up there a couple slides ago, and I added a couple of things to it just to see what was interesting about it. Because I have a feeling that some of the smaller companies, and by smaller I mean those that we define as having 12% growth or more, are the ones at the bottom. And I think what's happening here is that we're really evaluating this on what I think is two different tracks, if you will. When we look at the owner's return on capital, we're looking at what is the potential if we were to buy the entire company.
Right.
And that's the return that we would want to get based on our expectations looking forward. We want to have that rate of return. When we look at the projected annual return, we're not where we do factor into that a couple of other qualitative measures, in my opinion. We need to take into account what Mr. Market is doing, and we also need to take into account the expectations. And what I'm finding is, at least in my first pass at this, is that the size of the company, I think, has some real relevance to why, and five being at the bottom, is one of these small companies.
Right.
It's turning out that these small companies, and I don't want to sound too academic, but it seems like there's a premium being paid for the high growth. And that's what's making the differential between just a purely financial decision versus a financial decision that also weighs in the emotions and some of the risk factors that investors want to take. So if I'm going to buy a small, fast-growing company, I want to get a better return than if I just bought the whole company.
Oh, I like that.
That's where I think. Okay, that risk factor, Five is growing at 20%, and they've proved they can do it, and they can continue to do it. Mm-hmm. Somewhere down the line, they're not going to be able to, but certainly in the next 5 years or so, they should be able to continue to do it. And I think that risk factor is what makes the difference between, in my case, and I actually used a 33 PE, with 33, 34, they're the same thing, and you use a 24. My 33 takes in that risk factor of this small company stubbing its toe or falling on its face even.
Okay.
And so I want to be rewarded for taking on that risk.
Well, that makes a lot of sense. I mean, that what you're looking at, I think you would find that to be true, that if you looked at, and I didn't include the broader set, the 900 companies that we covered on last Tuesday, but you will find that well, first of all, if it's a highly cyclical company, it kind of goes haywire here, and that makes some sense to me too. But the faster growers, as you've described it, and Five is shown on here, they do tend to be more likely to drift from that line, and that kind of underscores. Again, I've only begun, although I've read quite a bit of Greenblatt's stuff, but I do know that he leaves out the the asset-based companies, and he also leaves out the small companies. In using this as a screening criteria for the stuff that he's done. So yeah, maybe there does need to be, and yeah, this slide actually bears it out. You can see the heavy growth down here at the bottom.
Right. I mean, all those companies, 26 is in there, 15% grower. Regeneron, 16% grower. Align, a 19% grower. Even Google is a huge company, but it's a fast grower. So, in our interpretation of small versus large, we look at the sales growth as being the defining factor, even though a lot of people would arm wrestle us that Google's actually a large company.
Right.
But you're getting paid the premium to take that risk on for that faster growth.
So maybe there's some kind of a bias or a bent, to considering this, and yeah, that makes some sense to me.
Okay.
Any comments from the audience on this?
Nope, not yet.
Okay. I think I'll table the Ardelyx conversation. Somebody asked about the fact that they've gone out for 20 million shares at $6 a share, which is going to put kind of a buffer or a damper on the stock price, although it did recover. I just wanted to point out for those of us that are tracking the company, they've done this before. And in fact, they took on some debt also. So they are fueling up for whatever they're doing. And I won't pretend to understand what's going on in the vats and trenches at Ardelyx, but they're gearing up for that, and it is precedented. And when you start looking at it in this type of a model, you start looking at numbers like this. And what I think is actually kind of cool is you can talk about a cash infusion that actually affects this number, moves this one around a little bit, and then if you're paying down some debt with the cash that you take on, can actually raise this one because you're taking away some interest expenses. So it's kind of neat to be able to think through, what type of capital structure, strategy, and decisions are being made, and how does it affect things. And the point that I would make is that the 20 million shares at 6 is actually a fairly small transaction, and it is precedented. So for those of you that are tracking the company. Okay, just a quick reminder that we are following these. We're tracking using owner's return on capital along with RSI and some of the really neat stuff. I think sometime between now and maybe a couple weeks out, we'll take a look at this notion of launchpad again, or some people have referred to it as escape velocity. Our friends in St. Louis, the ladies that have won the contest, they actually won it 3 or 4 times in 5 years.
Yeah.
And they have a simple premise of looking for the companies with exploding earnings expectations, no pun intended. And we need to take a look at that in a little bit more detail at some point here in the future, because we've actually found some fairly decent ones there. But again, we're kind of intrigued by the numbers at the top of that chart and want to get a little bit bigger sample and a little more runtime. So with that, I think I'm going to go ahead, and these are just some slides from the other night. Is Greenblatt the spelling of his name for those of you who want to follow up on this return on capital subject? This is becoming one of my favorite slides to point out. I really believe that those of us that are here tonight find a way to get between those two numbers. I'm talking about this number and this number. And it's really a neat thing when you see it happen in somebody's life. And, in fact, Nick wrote an entire, it was part of a newspaper article that was about precisely that this past week in the Pittsburgh Gazette. So with that, any other questions here? We're running at about an hour.
The only other comment in here is Marie wants to learn about what other people are paying for Wall Street Journal. She says she received 3 offers for subscriptions yesterday. and yeah, so she was wondering if we could do a quick poll of what people are paying for Wall Street Journal.
I don't know how much I pay. I can look it up and send it to you, Marie. I get Barron's and the Wall Street Journal as part of some kind of package, but I'll have to actually look at my bill to figure out what I'm paying.
Yeah, we get it at work, but our government affairs department pays for it, so I don't know what she pays for it. But I have her login ID, but don't tell anybody.
All right, well, anybody wants to post that in the manifest forum if you've got a subscription rate. And so 3 different offers, huh?
Yep, and she said all 3 of them came in the mail, which me working for as a nonprofit supporting the printing industries, I'm glad to hear they were all mailed.
Okay.
Okay, and we're all clear over here then.
All right, so we'll again, what I would like to hear from anybody out there that wants to either send me an email or a post on the forum transaction is this the type of thing that you would like to see? Where would you like to see us go? I would like to spend at a future session just getting a little bit more into the nitty-gritty details of screening, because that's something that many of you have expressed interest in. Let's do some of that live. And I do want to spend a little bit more time showing you guys what's going on with the data, which we are going to be spreading over into the mutual fund world here very soon.
I know personally I keep hearing people talk about that Y charts, and I haven't done any investigating yet, but I've got to.
And I don't know what their retail product looks like because I'm a institutional product.
Right.
But I do want to look at loading up an SSG data file using that data, because that can obviously run a whole bunch of stuff.
Oh yeah.
And I think we'll probably be tinkering with that. So we'll have a future session on those type of topics.
Okay, sounds good.
Anything else that people want to hear about? And maybe we will have one just specifically for groundhog hunting, not the hunting of groundhogs.
Well, my friends in Punxsutawney may get upset with you, but that's good to know.
Yep. All right. Well, thanks for helping out here tonight, Nick, and everybody else. I don't believe we will probably be touching base between now and Christmas, so a very Merry Christmas to all of you.
Absolutely, I agree. And a Happy New Year, and hopefully prosperous New Year. A couple of folks in the back room here saying Happy New Year and Merry Christmas also. So,
Yep, and our next roundtable is actually the first Thursday after New Year's Day. So,
first Tuesday.
excuse me, Tuesday after
That's
New Year's
okay.
Day. Okay.
Okay. Well, thanks everyone. Have a good evening.
Thanks, everybody.